Our next speaker for this morning is Daniel McDonagh. Daniel is the CIO at Perfect International and portfolio manager of the Nedgroup Investments Global Cautious Fund. Daniel, welcome, and it's so nice to have you join us today.
Thank you. Nice to speak to you today.
Brilliant. Daniel, let's jump straight into performance, please, if we can please start off with that. So how did the various assets in the portfolio perform, and how did that impact on the fund returns overall?
Sure. So the quarter was notable for being a strong one, mainly for equity markets. It seems that the tariff hikes are becoming or coming at a more gradual pace and perhaps being a bit more differentiated than the market was originally fearing. And you do get the sense that the equity market has begun to be more comfortable and maybe more composed in the face of those frequent and unexpected market-sensitive pronouncements that the Trump administration are prone to making. So on the back of that, the fund recorded an absolute increase of 1.4% in the quarter, and that meant that the fund was up nearly 7.3% for the year. And as you can see from the slide, it was really equities that led the way. Non-US equity indices were up over 16% in the period in US dollar terms. US equities were up over 18%, so that's a very strong backdrop. Against that, the fund's equities underperformed those indicative equity indices on both the US and the non-US basis, but that was because of the defensive positioning that we have in a somewhat exuberant market. If we turn to currencies, then over that 12-month period, European currencies generally strengthened against the US dollar. The euro, the Swiss franc, they were both appreciating about 5% over the period. Neither of those currencies were hedged, so the fund felt the full effect of that benefit. But on the flip side, the yen weakened against the US dollar over the year. That wasn't hedged either. So some toing and froing, some ebbs and flows in the currency markets. But it was really the bond side where the fund performed best. It posted a positive absolute return that beat the indicative indices on both the US and non-US basis. Was particularly notable, I guess, in the non-US bond market, where the index had a negative absolute return in US dollars of minus 0.5%, and we managed to protect against that by posting a 3.75% gain. So part of that was we've increased duration from 3 to 6 years in mid-January when US 10-year yields hit 4.8%, and reversed that at the end of February as yields eased back to 4.25. So that all added to returns, and that's really the picture on recent performance.
Great, thanks, Dan. You did mention about how the US equity index did quite well, so kind of returns of just over 18%. Just turning to the US economy now, would you say that there's consistency? So the underlying US economy, is that telling the same story as what we're hearing from kind of the stock market?
Yeah, it's an interesting question. Does it back up? And it's a question that we're always asking. What might disturb this tranquil picture that the markets have? We're very conscious that equity bull markets, they don't automatically die of old age. There has to be some kind of trigger usually that derails them. And for us as fundamental investors, earnings are the most important driver of the equity market. They're the key input into how the market evolves, and a big input into that is the underlying aggregate demand in the economy. And the two major components of aggregate demand are really consumption, so what households are spending, and investment, what capital expenditure plans that businesses have. And it's interesting here to see in this graph the conflicting signs that those parts of the economy are showing. We can see here that US private investment is growing at a very healthy clip. So CapEx is looking pretty robust at the moment. But the picture in the labor market is a bit less assured. Private employment there we see is declining of late. And that's part of the reason we've seen the bond market soften recently. And what's really interesting is that divergent experience between investment and employment, because as the graph shows, that's not been witnessed very often, if at all, over the last 60 years. So you go and ask, why is this the case? Usually in the past, if the animal spirits are high in the corporate sector, a boost in investment is going to go hand in hand with that increase in employment. Why is it decoupled? Well, one narrative is that it could be due to AI, just AI adoption leading to workers being displaced as the productivity enhancing potential of that is unleashed. We've seen mounting evidence that the hiring for graduate entry level jobs has been softening in recent months. And that could be seen as evidence that firms are using AI just to stop those more menial, repetitive tasks being needed to be done as often, those tasks we were all so familiar with when we joined the workforce. Alternatively, you could say that the capex boom has just been the result of the Mag 7 technology stocks, an unsustainable acceleration in that. So companies also trying to front load investment in advance of those higher tariffs. While the flip side is that the rest of the economy really frets about the uncertainty of the impact of those tariffs and so has stopped hiring. Whatever the reason, the key point to remember here is that the biggest component of aggregate demand is consumption. That's usually accounting for around 2/3 of the total demand in most developed economies, so much bigger than investment. So if employment and the consumer is beginning to falter, then that's a bigger issue for the economy than if capex dries up. Slower job growth has often been associated with a slide into recession in the past. So that's bad. But if both were to happen, then you'd really have a problem. And the narrowness of the capex splurge is a concern. By some estimates, the Mag 7 companies are going to account for over a quarter of all the S&P 500 capex in 2025. And this next graph really just emphasizes how staggeringly big some of those absolute numbers are and how fast the growth in spending is still accelerating. What's interesting, I guess, is those formerly asset-light companies that seem to be morphing into a much more asset-intensive model as they build these data centers. And the concern is that their equity multiples will start to reflect that. They'll start to shrink, and thereby cutting the incentive to invest so heavily in the first place. And if that happens, it's not going to help the economic growth numbers one bit. So that leaves question marks, we think, about just how robust both consumption and investment is going to be going forward.
Yeah, thanks, Dan. I mean, just on that last point, it's just scary how low revenues generated from AI currently is versus the amount of capital spending that's going into it. So anyway, let's see how that plays out. Just turning to government fiscal stimulus now, please. I mean, do you think that can continue to support markets as it has been?
Yeah, it's a good question, because clearly if you're not able to rely on consumption and investment is potentially a problem, then you traditionally look to government spending as the third big pillar of aggregate demand. And governments have been increasingly active in supporting households through recent times. First we saw the multiple furlough payments that would help shield workers from the lockdowns in COVID. And we saw significant financial support for European consumers, especially who suffered hardship when energy prices spiked after the Russian invasion of Ukraine. And that all comes on top of the regular, consistent commitments of pension and welfare liabilities that the state has. And what we're seeing is that, like a lot of the developed world, the US appears to have become somewhat addicted to public spending. Politicians are making a series of commitments that are probably increasingly unaffordable, but very difficult to reverse, because people simply don't reward politicians who cut spending with votes. So the capacity of governments to continue to open a checkbook and underpin the market is possibly going to slow. We see here on the graph that fiscal deficits are at elevated levels. We don't usually see those US and UK levels at periods outside of wartime or the peak of recessions. It's a graph showing the 2024 levels, but the magnitudes are expected to not really change too much for 2025. So I think it's an accurate picture at this moment in time. And those debt levels, they're causing debt metrics to deteriorate. And that's caught the attention of the bond markets with yields marching upwards earlier in the year. Of course, sentiment doesn't get helped when you see the rating agencies downgrade the US. Moody's stripped the US of its last remaining AAA rating in May. And all in all, it's just the perception of risk is increased. High yields are compensation for that, but as debt gets more expensive, that's going to necessitate a more conservative spending stance going forward. And that could be a further drag on aggregate demand and eventually earnings.
Thanks, Dan. I mean, it is always funny how politicians make promises and spend, and it's only long after they're gone does that actually need to be paid back? So anyway, let's see how it
Very
works
true.
out. And Dan, what about private credit? I mean, that market is booming at the moment. Is it something that actually worries you?
It is a concern, and if we look beyond the underlying drivers of aggregate demand, we've discussed consumption and investment and government spending. If you look back through history, you'll often find that it's an unforeseen issue that erupts that can rock markets. So in the global financial crisis, it was mortgage-backed securities that started those dominoes falling. So it's not always obvious what's going to shape the market before the event. But one potential factor to consider now, we think, is private credit. It has been an area of finance that's seen absolutely huge growth in recent years. It now provides a legitimate alternative source of funding to bank lending and the high yield bond market. But there are aspects of that market that we think gives food for thought. The first characteristic is that data can be a bit sparse. That's almost by definition. It's private markets, so it's private sources. But we think that's a little bit of a red flag in itself, because the lack of transparency means problems can be out of sight until they become a little bit too big to ignore. But it's not just that. The fact that 70% of private credit loans go to private equity sponsored companies, it means that most private credit is going to PE borrowing to fund itself from itself, which sounds a little bit circular to begin with, and doesn't engender a lot of confidence in some of the decisions that are made. It's also definitely true that because of its rapid growth, it's untested in a widespread economic slowdown. So whether the asset class is going to be able to withstand a weakening economy and a violent default cycle, that remains to be seen somewhat. And we'd argue it doesn't preclude banking sector problems either, because private credit often augments rather than fully replaces the role of banks. We all know how loans are sliced and diced and securitized and then traded, and that means that similar risks can reside on the balance sheets of both those banks and those private credit firms. Now, it has to be said at this point, it's true there hasn't been widespread carnage in private credit markets to date, but borrowers do have some options available to them that can preclude default. And what we see in this graph here is that payment in kind provisions have been increasing over time. Those are things that allow a borrower to defer interest payments and maybe add it onto the principal if they're having difficulty. And this graph shows that those payment in kind usage has been increasing of late, which could be a sign of increased borrower distress. And what we're seeing here is that the portion of dividend and interest income has marginally increased over time, and that's something that could potentially help to keep default rates artificially low. At the other end of the spectrum, part of the private equity story is exiting those investments, and we have seen some exit overhangs, an increasing portion of investments that have been on the books of private equity funds for a bit longer than usual. Usually they like to get in and get out, but that could be a signal that the exit strategy for the sector has become more difficult, and that's a bit of a bottleneck because investors usually want their money back on existing investments before committing even more capital to the industry. All these warning signs you could potentially say have been able to be visualized in the share prices of several private equity houses, which have been under pressure in recent months. So several of them down 20-30% off the top. Not conclusive evidence, but potentially a sign that something's happening. So we do think private credit is an area that may be scrutinized further if things start to sour.
Thanks, Dan. I mean, just hearing you talk about it does remind me of First Brands. And, not too long ago, everyone thought everything was perfect and happy. Next thing you get this blow up and it's a big shocker for everyone. Anyway.
A case in point, yes.
Yeah. But before we kind of close off with portfolio positioning, can we please just kind of summarize the discussion so far? And can I have your outlook on markets quickly, please? Thank you.
Yeah, absolutely. So if we bring it all together, the equity market looks very confident. It's marauding forward. It looks like nothing can derail that trajectory, but we are more cautious, as you would expect. History teaches us that that markets can be vulnerable when valuations are at elevated levels, and we think that's the case now. Those exact triggers, always a little bit difficult to pinpoint in advance, but the absence of market volatility shouldn't be mistaken for the absence of risk. And we've talked on some of those risks here, not least the potential weaknesses in all the building blocks of aggregate demand. Fiscal policy seems to be a bit constrained by the fiscal positions of the G7. Monetary policy is a little bit constrained by the refusal of inflation to go away. We've got a softening in labor demand. That can be a warning signal, and the strength of global capex is also something that seems to be quite reliant on a narrow portion of the economy. It feels like the center of energy is very much being driven by all things AI related. And what's really going to matter for that is whether the current investment that we're seeing in the area can generate enough returns to justify all that associated capex. So no conclusive answer on that yet, but quite a lot riding on it, given the narrowness of markets.
And then maybe you just want to continue and just go into the positioning of the portfolio at the moment.
Yeah, well, with that nervous kind of outlook, we do continue to be defensively positioned, both in bonds and equities. On the equity side, it means quite a modest 20% equity weighting in the fund. A lot of that in the US, which has been the market that's given the best returns of late. And on the fixed income side, we have a low duration positioning, and that's going to allow us to avoid any damage caused by a rise in yields if inflation becomes an issue again. So, in conclusion, it is a mature equity bull market. We think there are ample reasons to be cautious, and we think it might be in the longer term more valuable to sit on the sidelines than dance aggressively in this arena.
Okay, Dan, thank you very much for your time. Always lovely seeing you, and yeah, look forward to kind of returns over the next year or so.
Appreciate your time. Nice to speak to you.
Thank you. Bye.